Well, hi everyone, and welcome once again to Feeling Smarter. It's hard to believe, Tim, but this is our 100th episode. We haven't got poppers and streamers and stuff. We're just here to talk about good old Division 296 tax.
And what a way to celebrate. I'm sure that's how I'd like to celebrate everything to do with bringing up the century.
Yeah, correct. But it is, of course, a topic that has been very much a feature of our Feeling Smarters because the journey of these videos has really come about. Video one, of course, was on the objective of superannuation, which was naturally the plank that the government used to introduce this legislation in the first place. So it's somewhat ironic that we are actually talking about this in our 100th episode, which just goes to show how long it's taken for these laws to get to commencement. We're not even at commencement, of course, because we know it's still got to land in Parliament and then get through both houses in what is the second form. But we're not here to talk about that. We are here today, Tim, just to understand the impact of these measures on total superannuation balance. So can I get you to start on what we are expecting to see around total superannuation balance? And of course, we're going to see a new concept inserted around TSB value for each superannuation interest.
Yeah, so look, I think the interesting thing, Aaron, and probably part of, and you're referencing back to when this all originated. If we go back to the original DIB 296 bill that was introduced, I think the one pleasing element of that we all found was the redefining of total superannuation balance to unlock it as such from the transfer balance cap, because it always had this awkward connection to the transfer balance cap because they were introduced together. And of course, the total super balance was measured against the general transfer balance cap to determine eligibility for contributions and all sorts of other things. But it had this link to transfer balance to the transfer balance account, individual's transfer balance account, with reference to determining the value for pensions. And as a bit of it was always just a clunky calculation, which in 99.99% of cases came out to be that the value for the pension value for total super balance was actually the account balance at the previous 30 June.
Yeah, so we ended up with a modified version that effectively covered the large majority of the industry because of the fact that they're not defined interests, they're actually linked to an account balance of 30 June each year.
Correct. And so what we were really happy with the original announcement was that total super balance would be redefined to reference both accumulation and account-based pensions based on their withdrawal value as at the 30th of June. And so when we get to this new legislation being introduced, that's what we're going to see is this simplified definition of total super balance to reference the withdrawal value. And that's fantastic. So separating that from the transfer balance cap. We'll also see in the instance, particularly around DIB 296, we'll see certain elements of super, such as limited recourse borrowing arrangements, be removed from the calculation with regards to the total superannuation balance, which then provides a greater representation of what your balance actually is in the sense that you're not adding back in certain elements or certain like the loan amounts or whatever. You're effectively reflecting the net position of the fund at that time. And so this change is good because it really is truly representing what the value of the fund is on that day, to determine where you sit from an eligibility point of view for DIB 296.
Yeah, and I think the other thing that's worth noting here is that concept really bore out of it the fact that we needed to understand the difference between someone's account balance and what someone's total superannuation balance is, because the termination value or the value at a particular point in time as if they were to exit that interest in the fund is really important. So this is still going to be front and center of conversations that we're going to be having with clients, because we still can factor in elements such as transaction costs, the tax effect of balances and stuff, which were all relevant in the context of unrealized values and what we needed to, in terms of the movement, but it's still going to be relevant here as well.
Yeah, and I think that's really important to understand, is that that tax effective accounting and deferred tax liability, future income tax benefit. You've got to take the good with the bad in the way that you explain those sorts of two concepts, but they all become relevant here. And I think that was one of the things that we identified through this last few years was how many people didn't necessarily, because they don't have to, use tax effective accounting in the SMSF space. And I think with a focus of capital gains tax, which is something that we'll probably discuss through these videos at some point in time, the whole idea of, what is the actual gain? Because we've got to factor in all these other elements and determine where we actually sit. And one of those elements is tax.
Yeah. So the TSB naturally then, so we're talking about how we're coming to determine its value at a particular point in time. It therefore, in the context of these new rules, beyond the first transitional year, TSB is going to be important at both the start and the end of the year.
Look, it's an interesting piece, because what we're seeing with this new legislation, and this is a real move away from the former Div 296 calculation and the reference to total super balance is, and you highlight and you mentioned there about, say, from its introduction and moving forward, is in year one, so the 26-27 year, we will see Div 296 operate largely as we expected it to operate, which is based on your total superannuation balance at the end of the year, right?
Yep.
What we then see once we've moved through what they're calling this transitional year is that your total super balance will be based on this concept of your total super balance value, right? Which is the highest total superannuation balance measured as either the balance at the end of the year or the balance immediately before the first day of the year. So effectively, it's either the end of the year that you've earned the income, what is the balance at that point, or the balance from effectively the end of the previous year. Which one will be the highest will determine your balance for the proportion of your fund over the large superannuation balance for working out the tax liability. So it's kind of a cake and eat it too approach. Outside of year one, it's a cake and eat it too approach, in the sense of if you were over 3 million or you end up over 3 million, whichever one puts you highest is the point that we're going to utilise, and I say we being the regulator in this instance, is what we're going to utilise to determine your liability.
Yeah, so the thing that really stands out with this now is the importance of working within your boundaries. So what I mean by that is we have a boundary line on one side of the oval that deals with opening balance.
Yep.
And we have a boundary on the other side of the oval that deals with closing balance. Now, whilst we're in play on the field, we can kind of do what we want. But if the ball goes over the line at the end of the year, then the umpire will make its decision not only on whether the ball has gone over the line on that side, but maybe whether they thought the ball had earlier gone over on the other side of the oval. It kind of sounds weird, but that's the approach that they're taking. So there are clearly circumstances whereby during that period of the year where there is a capital gain that has been disposed of, and that increase in asset may be substantial. You have a death of a member, there may be a reversionary beneficiary, and it brings that person into it. You have a prescribed period of time before you get to the end of the year where you can take action without really being impacted to its fullest extent by actually taking action before then. And I think this is something that many people need to get their head around, because where you might be doing things once a year from a compliance context, the horse will have bolted by that stage. So this is where the ongoing administration of these funds will become really important, to see what events are happening and to plan within that time period, noting that in some instances you just might not have the time, because if someone's died on the 27th of June and it automatically reverts, well, you're not going to have that same flexibility potentially to deal with that as you would, say, when someone in the same circumstances may have passed away in August.
Yeah, and look, and I think there's a bit to work through it, and you know, and year one is going to be different to year two,
yep.
and beyond in that regard. And so year one specifically, you've got that effectively that movement time where something can happen and you can work towards bringing your balance down. Of course, then once we move beyond that period, and also, and just to highlight too, that there's also transitional rules for people that die in year one as well versus
yes, there is.
Those that die outside of that. So if somebody dies in the 26-27 year prior to the 30th of June, and they're not going to be eligible for DIV 296. So there's all the ramifications to build around that piece. So yeah, it's understanding and having that clarity. You know, and I spoke recently to a group of people, and they said, "Wow, this DIV 296 stuff is far more complex than we thought it could ever be." And I think, you know, if you're not living it day to day like we are, people are going to have troubles getting their head around the fact that we're using superannuation as the tool to determine a personal tax liability. You know, and so trying to separate those two elements is pretty critical, and then separating year one versus the other years to work out and understand when you will or won't be liable for DIV 296, and historically under the old measures to know that, you know, if you manage to get your balance down below that 3 million at the end of the year under the old measures, then you weren't going to be subject to DIV 296. Whereas now, you know, they're going to look at the start and the end and go, well, if you were ever eligible, you're eligible, right? Or liable is a better word for it. If you're ever liable because of your balance, then you're going to be liable during that year. And, you know, your actions during this current year or that year are not going to help you out, but they might help out for the following year.
Yeah, absolutely. Well, I think it's fair to say this is a topic that sits front and centre in our upcoming SMSF days around Australia. So from the 17th to the 31st of March, we still have our early bird on at the moment. Ticket sales naturally also very strong. So whether you want to attend live in one of 5 capital cities around Australia or attend our live stream, understanding these issues, utilising our case study to help unpack not only TSB, but a range of these decisions such as CGT adjustments and much, much more will naturally all form part of it. So you can visit our website, smartersmsf.com/SMSF day. Tim, happy 100th episode.
And to you, Aaron.
Excellent. Well, thanks everyone. Have a great rest of the week. Take care and bye for now.